going on right now?
Well, I mean, it's quite blood-ready when you look at the market, right? But it's not unexpected. You've been talking about this for a while now. We have left the era of the hyper-globalized world where we are just getting along just fine amongst the traditional allies. So welcome to 2026. I think this is going to be the sort of year that we're going to talk a lot more about what it means not to have the U.S. play ball with the traditional allies. It's going to have an impact on oil prices, commodities prices, equity markets, debt markets, private credit, you name it, we have it. And I think it's going to be the foundation of the basis of a different sort of Europe and European Union markets as we go forward.
Is there a danger in Trump's tactics here that he drives some traditional allies towards China more?
I think that's been the question that people have been asking for a while, although I don't think China is a natural replacement, if you will, for the United States. I think what is more likely is for Europe, and companies in Europe in particular, to really get going in making the necessary changes, not in rhetoric, but in action, to make sure that there can be an independent Europe vis-a-vis the defense apparatus, but also interdependence to U.S. markets, which is not going to be easy. So Europe has to be independent. And I've been quite a vocal critic of the way European Union policymakers have not acted so far. Now, if this doesn't get them moving, Ian, I don't know what will.
Well, to that point, I was reading a piece from George Saravelos at Deutsche Bank saying that, when you look back at the Munich Security Conference and J.D. Vance's memorable speech there, that's ultimately what catalyzed this, enormous change from the Europeans, from the Germans in particular, got them to spend in a way that they haven't done for decades. What exactly could this catalyze if the latest, remarks from President Trump and these latest threats are actually going to drive cohesion and action from Europe?
Juliana, the change has to be in the mindset, less so the fiscal stance. Europe will find the money. I mean, although we are witnessing the debt markets and investors finding it more and more difficult to price long-term debt, which will have an impact on cost of debt, cost of capital going forwards, Europe can still find the money. But it's the mindset. It's the intention to be able to act quickly so as not to miss the innovation train, so as not to miss the defense enhancements. And they have to stop talking and start acting. Again, this is the shift in mindset we're looking for. Now, I'm heading to the World Economic Forum after the show. I'm very curious. Been going there for 10 years. There's always been some sort of a talk up and down. But this year is going to be quite important to understand whether there will be a realistic, pragmatic way forward. I don't expect this to come quickly. But again, looking at the market, looking at this beautiful, not so beautiful sea of red, this has to get them moving.
In terms of the market reaction, you noted in some notes you shared with us before coming onto air that U.S. markets are bullish on an aggressive foreign policy agenda from President Trump. What makes you say that the U.S. market likes this aggressive agenda?
Let me qualify that. I think U.S. markets, by their very nature, are bullish U.S. market-led economies, right? And in U.S. is leading on innovation. Let's not forget that. No matter what happens within the Western Hemisphere, there isn't a single other market that can achieve the scale and size that the U.S. is going to provide. From a mindset perspective, liquidity, innovation, and by the way, a relative hedge towards what's happening outside. So therefore, Wall Street is quite good at digesting complexity and volatility, which is what we are living in right now, and kind of going forward with it. That's what I meant. What I think is going to be a more difficult story to digest is going to be what happens to the commodities markets, especially the oil and gas markets, with what happened in Venezuela. Now, there's one argument that says, you know what, it won't be a cheap exercise to try to get Venezuelan oil into the market. Fine. But once U.S. does manage to sort of stop Venezuela selling its oil to China, which effectively they have done so right now, and somehow control the Venezuelan oil, U.S. does become a swing oil producer of sorts, which is going to be detrimental for the traditional adversaries like Russia and Iran, but also countries like Saudi Arabia are facing the potential of being a collateral damage in this war, which is going to be major for GCC economies.
Just to home in on US equities for a moment, there have been a couple of interesting developments over the last week or so. You touched on oil there. Exxon made it very clear that it wasn't particularly interested in going into Venezuela. The president didn't like that. He was rattling the bars on Friday about JP Morgan, threatening to sue them for debanking him. Do you get the sense that some US CEOs are actually getting a bit of backbone in their dealings with the president at last?
Look, I think they are. I think they have to. Again, this isn't just a one-size-fits-all. What's happening within the U.S. is also uncharted in terms of where we are, at least for the kind of past 100 years or so. So it's not going to be easy for U.S. companies to get along with Donald Trump. Because I think Trump 2.0 is remarkably different to Trump 1.0. And everyone is just trying to figure out a way forward. Now, what the ExxonMobil CEO said is true in that Venezuela is difficult to invest in. But it's a matter of patience, capital, and profit. Now, if that setting becomes available, I'm sure they will go in. When it comes to banks, of course, there's a lot of debate about capping the interest rates at 10% on credit cards, which is going to be a major kind of setback for all banks. And I think it's going to be rhetoric. I think we'll see a lot of these matters be taken to the judicial system, so the courts. But markets, Wall Street is just great at absorbing complexity and seeing what traders want to see, which is alpha creation and growth.
Yeah, I mean, we've had such a blizzard of Trump-related news stories over the last 3 or 4 days. I mean, another one, of course, was that he indicated that Kevin Hassett was now not necessarily his preferred choice for the Federal Reserve. What does that tell you about? I mean, the market now seems to be pricing in Kevin Walsh as the next Fed chair. Implications for US monetary policy?
You know what? I think the confirmation process of any and all Fed chairs have never been truly that smooth. So from the perspective of what has happened between Trump and Powell, you know, it's not the first time this has happened. What is unique is the way that Powell and the Fed chair has responded to these criticisms. So it's actually out in the open, which brings forward a different sort of camaraderie against a potential meddling with the Fed's affairs. So whoever gets confirmed next, unless the legislation changes, I suspect that they will still be mandated to do what is best for the U.S. economy. By the way, not the world economy. I should underline the U.S. economy, but act independently. So I don't think markets are going to have an issue pricing that.
It is remarkable to see how quickly the poly market odds have changed. Just looking at it this morning, the odds for Hassett have fallen from 34% on Friday to just 8% this morning. So clearly, Kevin Walsh now seen as the front runner at 61%, according to Polymarket. Ozan, thanks for always being willing to jump onto the absolute latest news flow for us. And good luck in Davos. We look forward to catching up afterwards. Ozan Özkral, founder and managing partner at Tanto Capital.